Welcome to Stormwatch, your source for crypto news, market insights, and practical guides.
The global financial system operates on a foundation of trust, credit, and confidence in sovereign currencies. When that trust erodes, whether through excessive debt, policy mismanagement, or geopolitical shocks, currencies can face rapid destabilization. This video examines a conceptual framework for a potential US dollar collapse, progressing through 5 sequential phases: deflation, inflation, hyperinflation, currency crisis, and currency reset. While theoretical, this model captures patterns observed in prior currency collapses and highlights the interconnected dynamics that shape systemic breakdowns. Phase 1. Deflation, the onset of crisis. Deflation marks the initial contractionary shock to the economy. It typically emerges during severe recessions or financial crises when demand collapses. Key characteristics. Governments respond with emergency monetary and fiscal measures. Public sentiment shifts sharply toward fear and liquidity hoarding. Central banks inject substantial liquidity, effectively printing money to stabilize markets. Though these interventions can avert immediate collapse, they often lay the groundwork for future distortions. Phase 2. Inflation. Liquidity translates into price pressures. As newly created money begins circulating, the economy transitions into inflation. Notable developments. The influx of money increases aggregate demand. Purchasing power erodes as goods and services become more expensive. Heavily indebted governments and central banks face constraints, raising interest rates to tame inflation risks, triggering mass defaults. This policy paralysis enables inflationary pressures to deepen. Transition point. From inflation to hyperinflation. Recent Federal Reserve policy reveals signs that the economy is moving from Phase 2 toward Phase 3. Despite a series of aggressive interest rate hikes to cool prices, inflation has proven persistent, while federal debt levels have surged to historic highs. Servicing this debt at higher rates has ballooned the government's interest burden, forcing policymakers to walk a narrow line. Raising rates further risks a credit crunch, bank instability, and recession. Lowering rates prematurely could reignite price spikes and weaken the dollar. This policy trap erodes confidence in the Fed's ability to maintain price stability. If inflation expectations become unanchored while debt monetization continues, the US could tip into accelerated currency debasement, a hallmark of hyperinflation. Phase 3. Hyperinflation. Loss of monetary credibility. When inflation accelerates uncontrollably, hyperinflation emerges. Critical indicators. Prices surge at exponential rates, sometimes daily or hourly. Public protests and social unrest become widespread as real incomes collapse. The erosion of monetary trust disrupts economic activity, destroying savings and undermining long-term investment. At this stage, currency ceases to serve as a reliable store of value. Phase 4. Currency crisis. Breakdown of dollar hegemony. Hyperinflation culminates in a currency crisis, marked by a loss of confidence in the US dollar itself. Key outcomes. The dollar becomes increasingly expendable in international trade. Investors and foreign governments seek alternative reserve currencies. The International Monetary Fund, IMF, intervenes to coordinate emergency stabilization efforts. This phase represents the functional collapse of the dollar's global reserve status. Phase 5. Currency reset, a new monetary order. The terminal stage is a currency reset, where the global monetary architecture is restructured. Possible elements include the IMF introducing special drawing rights, SDRs, backed by a mix of gold, digital assets, and major sovereign currencies such as the euro, US dollar, and Chinese renminbi. Establishing a multi-currency reserve framework to reduce reliance on any single national currency. Enhanced global oversight to mitigate future systemic risks. This marks the emergence of a post-dollar era aimed at restoring financial stability and investor confidence. Conclusion. While this 5-stage progression is a theoretical model, it underscores how swiftly monetary systems can unravel under stress. A collapse is rarely the result of a single event. Rather, it reflects compounding policy failures, unchecked debt accumulation, and eroding trust. With current conditions suggesting a fragile transition from inflation toward hyperinflation risk, the stakes are rising. For policymakers and market participants alike, understanding these dynamics is critical. Preparing for potential disruptions through diversification, prudent debt management, and international cooperation remains essential to safeguarding global financial stability. Please visit MoneyStorm for all your cryptocurrency educational needs.